premium for a product that you think is going to go higher, whereas the person selling you it thinks the price is going to go lower, don't they? Whereas a collar is just a slightly different options play. A collar is something where you obviously have, you know, you cap the upside and you potentially cap the downside of something. You collar it. So in other words, it hasn't got any room to go to the upside and it hasn't got any room to benefit from going to the downside if that's what your position was. So, for example, in the mortgage market, there's a lot of collars in place. So there's a lot of collars in place in the mortgage market. So certainly in the UK. So if this is the current mortgage rate, for example, here. So if we had a mortgage rate there, obviously if I own that mortgage, so I'm the owner of the mortgage, right? I don't want to, what the hell am I typing here, guys? Brains went blank. Anyway, so if I own the mortgage, the one thing I don't want to do is see interest rates going massively higher. So I can buy a product that covers myself if interest rates go above this level. So I can buy a product that covers me if the interest rates go above that level. So the maximum I'll end up having is this level, right? Now on the other side of this, I might say, well, that's quite costly. That's a costly piece of insurance, right? So that's a costly piece of insurance, yeah? So say that costs me $1,000 a year for that insurance product. I might never call on it. But obviously what I could do is I could sell the bank this position here. So in other words, that means that I won't benefit. If rates drop below that level, right? I won't pick up any benefit. I won't get the benefit if rates were to drop through that level. And obviously that level, if the interest rate market was very bullish in terms of rates, that's not going to make very much money, right? So I would sell that back to the bank and I'd say, right, well, how much is that worth? The bank might say it's worth $200. So my net premiums on that is going to be $800, yeah? So you could say to the bank, well, you know, what would give me what is called a nil cost collar? What would give me a nil cost collar? And they would say, well, if you sell as an interest rate and you agree that the interest rate is slightly higher here, for example, then we'll cover that for you. And they'll give you $1,000 for that position there. So in other words, your interest rate might go up slightly from where you are just now. You might have to take a little bit of a move higher in interest rates for you to get that $1,000, but now you've got a now you've got a nil cost collar. Now it doesn't mean you're going to save money, because you're not going to save money. But what it does mean is you now have a maximum cost to your mortgage. Your mortgage will never go above this rate here. So even if mortgage rates went like this, even if mortgage rates went straight through this, you would never have a rate above that level because you've basically bought a nil cost collar. But equally, you're paying a little bit more for it in terms of rates. But obviously, if the rates also did this, you would not benefit from a drop in rates either because you've given away the benefit for the sake of having a collar. So basically, again, it is a kind of swap, isn't it? I mean, you've swapped the variable basically for a collar position, right? So you've swapped. So this is a swap as well, isn't it? You've swapped a variable rate for a fixed range. It's not a fixed rate, but it's a fixed range. Would you agree with that? So you would just say now that would just you don't sell the bank your mortgage, right? You don't effectively sell your bank the mortgage itself. What you do is you come up with a swaps contract, and that swaps contract details what the transaction is, what the levels are, how long the contract lasts for, and it has a premium price attached to it, or as I said, a nil cost attached to it. And, you know, that's obviously the swaps market. But basically, the swaps market is enormous because no assets actually really change any hands, do they? No assets really change hands. The swaps market is absolutely ginormous. It's a derivative product, right? And when you think about it, credit default swaps are a great example of what we've just been talking about, right? So credit default swaps is an insurance product. Credit default swaps is what we've been talking about regarding Citigroup, right? Not Citigroup, it was Credit Suisse, wasn't it? So we can obviously understand that the credit default swap market is also an enormous swap. It's an enormous swaps market. And obviously what you're doing then is basically insuring debt. So there's a complicated process, but let's assume you're a borrower here. So you're a borrower here, and you've got a borrower rating, say of B minus or something along those kind of lines, and you're thinking about borrowing. You're thinking about borrowing $100 million, and you've got a rating of a B minus, and then you've got a bank over here, and this bank says we'll lend you $100 million. We'll lend you $100 million, but we only lend to A-rated companies. Okay, so how does this transaction take place? How does this transaction take place? Well, the borrower goes into the swaps market and says, can I buy perhaps even some credit, insurance? Can I take somebody else's rating? So somebody comes in and says, we'll sell you our rating for a premium. We'll sell you a rating for a premium. So they will go to the borrower and say, we'll charge you a premium of $3 million. And what this guy here has an A rating. This guy here has an A plus rating. And what they say is, we'll sell you for a $3 million premium, we'll sell you our rating basically, and then we'll get the loan from institution here, and we will basically route it through, okay? So you end up getting this credit default swap. You're swapping out your rating for somebody else's rating. They're taking on your risk. But the bank itself in this position here, they are technically insulated, but they're not really insulated, are they? Because it all depends still about whether this group here is any good. But ultimately, it's still about whether this guy's any good. Because if this guy defaults, this guy's in serious trouble for $100 million. And if their A rating is a little bit shaky, then that could knock on effect through to this guy here, couldn't it? And this guy here could be down a toilet. Somebody somewhere has to be big enough to pick up the bill, correct? If that 100 million defaults, somebody somewhere has to be big enough to pick up the bill. And that's what obviously the whole contagion effect of the Greece, for example. Remember the Greece run on the banks, and everybody talked about the European Central Bank came out, Draghi came out, and he says we will basically support every penny of these things, because basically the ECB said, well, we need to, because the banks are just going to get absolutely annihilated. Banks are going to get absolutely annihilated. So obviously the idea is to try and encourage people into this market, and if this premium goes up to, say, and this is when you start seeing premiums in the credit default swap market, say it goes up to 15 million, what does that tell you about the marketplace? Say the premium on that $100 million goes up to 15 million bucks, it means that nobody can borrow, right? Market's absolutely busted. So when you see massive increases in credit default swap premiums, there's real big trouble. Well, in some ways, that's what the LIBOR market is. When you think about LIBOR, the LIBOR is the rate that banks borrow from each other, right? So when you think about the London bank rates, you can start to say, well, if that's the rate that banks borrow from each other, and that rate keeps going way above risk-free assets, there's a problem in the asset world. There's a definite problem in the banking world. There seems to be some systemic risk kicking off in the background that I need to now pay attention to. So that's perhaps some of where these problems lie. But the swaps market, it all depends what the swap is that we're talking about. You can basically swap anything for anything, and could be a swaps contract. You don't actually have to part with the actual physical underlying product. You just sign a contract, and obviously the contract just expires basically, and the contract has a premium. So it depends what you're swapping for what. I mean, it's just such a broad market. It's almost impossible to quote out what the swap is. You know, obviously you've got things like carry trades, fixed interest rates against variable interest rates. You've got currencies against currencies. You've got products against products. It just depends. You know, it just depends, and that's something that the banks do a lot of on the swap desks. A lot of business take place in swap desks without physical assets ever having to change hands. So you come across swaps yourself a lot. If you've got a fixed rate loan as opposed to a variable rate loan, that's a swap. You can swap that out if you can change it from a fixed to a variable. That's effectively a swaps contract because the loan itself doesn't change, but the nature of the loan, the terms of the loan effectively change because you've issued a swaps contract in between.